Is AI actually a massive wealth-burning machine? Wall Street has sold a structural paradox, and it's about to be exposed. They're using short-term money to fund long-term assets, and when the music stops, it's your wealth management products that will pay the price. Stay with me for the next couple of minutes. Missing this could be the most expensive mistake you make this year. The giants are stumbling. Blue Owl just took the nuclear option, freezing all redemptions for its OBDC2 fund. Translation: the money is trapped. Even Blackstone, the king of the mountain, is bleeding. Their $82 billion fund has seen $3.7 billion in "Get Me Out of Here" requests since January. Apollo, KKRA, they're all selling, but nobody is buying. Is the economy failing? No. It's scarier than that. It's a liquidity crisis. To understand why this is so dangerous, we have to look back at the 1990s dot-com boom. Back then, Cisco Systems was the undisputed king of internet infrastructure. They aggressively poured billions into routers, switches, and fiber optics, building the pipes for the future. But they built too much, too fast. This overcapacity far outpaced actual demand. When the crash hit in 2000, Cisco's stock plummeted by over 80%. Today, the AI arms race looks hauntingly similar. We are building massive data centers and snapping up Nvidia chips at a record pace. But is the demand actually there, or are we just repeating Cisco's $500 billion mistake? We know AI is expensive. We're talking trillions for data centers and chips. But where is the money coming from? It's not just coming from tech giants' balance sheets. Meta moved $27 billion into shell companies, SPV, from Blue Owl. Oracle used $15 billion from Blue Owl and JP Morgan. Elon Musk's XAI borrowed $12.5 billion just to snap up Nvidia chips. A consolidation of reports estimates tech companies have sucked around $450 billion out of the private credit market. That's nearly 1/3 of the entire $1.8 trillion market. These innovations are being funded by a market that is currently facing a bank run. How did we get here? After 2008, banks got strict. Private equity firms like Blackstone stepped in to fill the void, lending to companies banks wouldn't touch. But they ran out of their own cash, so they turned to you, the individual investor. They invented a semi-liquid fund. It promised high returns and the ability to pull your money out quarterly. But here's the problem. You can't use fast money to fund slow assets, a 7-year loan for a data center. In prosperous times, the model holds. But when things turn sour, problems emerge. Two things are killing the dream. 1. Obsolete assets. Investors realize many companies borrowing this money are SaaS firms that AI might disrupt tomorrow. Unclear valuation. These loans don't have a market price because they are held privately. The valuation is unclear. When Blackstone and KKR started marking down their values, the smart money realized the paper gains were an illusion and ran for the hills. Regulators claim there's a firewall protecting ordinary people. They're wrong. The firewall is full of loopholes. There are reports that insurance companies have moved premiums into these funds. Banks have lent hundreds of billions to these private equity firms. The entire AI story is built on a house of cards made of private debt. If AI profits expectations don't align perfectly, or if the private credit market collapses, the decline won't be a slide. It'll be a cliff. The market is currently all in on optimism, but they've run out of ammunition. Proceed with caution and triple check what you have invested in. I'm Panda, guiding you through the global wealth landscape. Hit follow to stay ahead of the curve.